EZZ Life Sciences. Now, bad day for them because I'm making a video on them and they have a scam warning on their website, but don't worry, it's not them. They have people that are trying to scam people through emails. Join the club. It's getting worse every day. I get a scam text or a scam email every day, it seems like. Now, this company's revenue in 2023 full year, it's up by 147.3%. They have revenue of 37.1 million, EBITDA of 5.1 million, up by 167%, $13.8 million cash, also up. Gross margin up to 76.8%, up from 50% last year. They're profitable and they have a dividend. I will say that again, they are profitable. Now, the fun part for me, you're thinking, Cameron, where in the world did you find a penny stock like this? Australia. This is my first ever Australian penny stock. They're based out of Sydney, and we need to go take a look at this one. You're watching Common Sense Investing. My name is Cameron. Let's go find a great Australian penny stock. Here is what they do, their products. So they formulate, produce, market, and distribute health supplements under their brand. So that's one of the main things. You could see some of these supplements here. I have no idea what any of this does. Bone growth chews? What in the world is that? As well as they're an exclusive wholesale distributor for Eoron. No idea if I pronounced that properly, but that's in Australia and New Zealand with a whole bunch of more products here. Now, that's not all their products. I mean, they reaffirmed some financial highlights here, which are really good. Some new distribution channels we'll talk about here in a minute. But mostly, they have 18 new products under their own brand in 2023, as well as a few more under that Eoron brand. So this continues to grow. We looked at this briefly already, but it's worth a second mention. So 37 million of revenue in the year, that's up 147%. EBITDA 5.1 million, up 167%. This is a massively growing stock if you look at these numbers. Cash on hand, 13.8 million, up by 32%. No external debt. Gross margin improvement, we'll have to go ask this question. How did it go from 50% to 76.8%? That's quite an increase. Net profitability here up by 176% to 3.6 million. And they handed out a dividend of almost 1 penny. So apparently these Australian stocks really like their dividends. Revenue drivers are here. And one thing that's important to understand the margins is the revenue from Eoron is down $2.3 million. As you could see in the second part of 2023, it became less important to the revenue of this company. And that explains the margin change because Eoron right here, their margins are in the 20 percentile, 23%, 26%, while the EZZ brand products are in the 80s, 83 and 84%. So the more revenue they could get from their own branded products, the better for this company. And that's driven profitability. Everybody's looking for a growing, profitable microcap stock. They definitely fit into that bucket. Landmark partnership with HIC with sales commencing in the first half of 2024. Gradual resumption of inbound leisure travel from China to Australia and New Zealand. Pipeline of new products. Actively exploring new geographical markets. Strong cash position. They might buy up a company. So the first thing they want to point at is this landmark partnership with HIC. What is that? So this is a Chinese e-commerce partnership, HIC. The company's name is Obey Pty Limited, HIC. That's strange. 2-year deal expected to result in an additional $16 million of revenue annually for this company on 2 products. So that's pretty important. And the company agrees with me, saying that to put that into context, the company's full year sales revenue was $37.1 million, and this partnership should increase that by $16 million. But here's the thing, stop, right? This is all looking bullish. You don't know the price or anything else, right? You don't know much about this stock. I didn't either. So let's take a quick look because this is one of the bullish things for this stock. This is one of my green flags. When we look at EZZ Life Sciences holdings, as I recorded today, up 7.75%. Now, in all fairness, this stock was pointed out to me and researched and discussed in my Patreon by one of my Patreons. They have rebounded back up to 62.5 Australian cents. They have a market cap of $26 million. They have an implied shares outstanding of 43 million, and a float of only 10 million, as insiders own 76% of this company. That might be too high for some people. Some people love high insider ownership like that, some people don't. But based on all those numbers that you heard so far, 147% growth, 126% growth, whatever it is, you would think that this would be a highly valued stock. It isn't. They're saying here $43 million of revenue, pretty explosive quarter over quarter revenue growth, positive EBITDA, and they actually have diluted earnings per share of 8 cents. When you go over to some of their valuations on that earning per share of 8 cents, trailing PDE of less than 8, enterprise value over EBITDA of 2.88, only because they have so much cash on hand for such a small company. Price to sales is 0.61. Price to book of 1.74, enterprise value over revenue 0.33. So this does not look overvalued to me in any way, shape, or form. I'm looking at this thinking, wow, okay, $12.6 million in cash. The reason their quarterly earnings year over year seems to be down is they did pay that dividend. I'm not so sure if they can afford to pay that all the time, but they keep doing it. So you have to think, okay, it's an Australian stock. I don't cover a bunch of Australian stocks. What am I missing here? Because that's pretty good growth for a company that doesn't seem to be overvalued. Last week, they put out a new presentation here for the first half of 2024. Revenue increases are continuing. They're still probably paying out some dividends. They have a very short history, but it seems like this year is the year that they plan on growing what they have already built, like so many companies are doing. I always say let the company try to convince you to become a shareholder. They have some very good reasons to at least take a look at this company right here, including talking about their marketing channels, improving their financials, which I agree with, growth opportunities that are still to come. This is worth a pause and a read. But I think what caused the recent share price decline is the first part of 2024. Their EBITDA actually decreased 12%. Their profitability decreased 12%. Their interim dividend, which they're still putting out for some reason, is still there. They still have 12.6 million cash on hand, even though their revenue is up 43% and their margins are staying at roughly 70% plus. They're getting less profitability from that. I think people were concerned, and I wonder where the decrease in profitability is coming from. It's not a lot, but when your revenue is up 43% and your EBITDA is down 7%, you have to ask questions. People are really enjoying this stock the past week or so, though. I know that their EBITDA is down on higher revenue, but all of a sudden they're getting good green volume and prices up. So I did think that it was quite undervalued. It's back up to a decent price right now, but it's probably still undervalued. And when we talk about slightly undervalued, you can't say, Cameron, it's an Australian stock. You don't know what you're doing. Stay away. Because I thought the same thing myself. I put a lot of research into this company. I realized EZZ Life Sciences Limited, VLS.AX, does the same bloody thing. Formulating, packaging, manufacturing, shipping, marketing, supplements, and vitamins. Same as EZZ, basically, right? They're sitting here, Vital Life is, with $137 million market cap. They have a float of 20 million shares. Again, look at all Australia stocks like this, 79% insider ownership. That's huge. The difference is here, they have just under double the revenue of EZZ. Quarterly revenue growth isn't as high, right? A lot of similarities, more earnings per share. I have to give them credit for that, right? 17 cents earnings per share. I think EZZ had 8. When you look at the numbers, trailing PDE, 14.7, price to sales 1.8, EV over revenue 1.6, EV over EBITDA. Like their valuation is much more reasonable. When I look at Vita here, I say, okay, this is a reasonably priced stock. When I look at what EZZ was showing me, I thought, something doesn't match out here. Now, what seems to be the case is that there has been concerns about EZZ Life Sciences distribution in China. What if they lose that market in China? And when those fears happen, when those fears hit social media, people get worried and they sell, causing these large dips in share price. The thing is, it looks like there's absolutely no indication they're going to lose that Chinese market because they've had all this bad news already baked into their share price. It looks like they're recovering. Maybe it can go up to something more like Vita. And at the end of the day, What do you think? I'm not going to give a bunch of green flags and red flags like I usually do. I think I pointed them all out in this video talking about EZZ Life Sciences. I just wanted to connect what could be a good company, it could be a good stock, to hopefully some good people, some good investors. Australian investors, what do you think? What am I missing with EZZ Life Sciences? Let me know. I'm always looking to learn. I can't wait to see you again. I always appreciate your time. You've been watching Common Sense Investing. My name is Cameron. I'll see you again soon.